Have you heard the one about a 50-year mortgage? This is your host, Ron Wojciechowski, for the Black Hole of Real Estate, and it's been an interesting week regarding this talk of a 50-year mortgage, and a lot of people have been really quick to dismiss it as a really bad thing for consumers. And there's a part of me that thinks that that's a long time. But I thought this through, and it may not be as bad as some think. Now, here's all the negative stuff that you're hearing. 50 years is a long time. You're never going to pay it off in your lifetime. And there's going to be 20 more years of interest tacked on compared to a 30-year loan. And most of the payment that you make in the beginning goes to interest, so you're not going to get to equity as quickly as a different type of mortgage product. Okay, I think that's really easy to understand. But let's examine the fact that most people move, if you look at averages, every 7-8 years. And we know that more than 95% of interest in most cases on a mortgage happens in the first 5 years. So what I'm saying is this: 95% of your payment goes to interest in your first 5 years or thereabouts. And if that's the case, then you're almost paying off zero, maybe a little bit in the first 5 years. And if you had a $300,000 mortgage and 95% went to interest, you paid off $15,000. It's not a lot. So how much less would it pay off in a 50-year? I don't know. Maybe 5. We can run some numbers on that, but it's not a huge difference in the first 5 years. And if people are moving every 7 to 8 years, I think that the upward lift of equity is about the same, knowing the payoffs are relatively close. Certainly within $15,000, if that's what we're looking at. So with that in mind, allow me to introduce you to some of the upside of a 50-year mortgage. The first thing is that the monthly payment is going to be way lower, which will allow more people to qualify for a home at a higher price or something that they might really, really rather move into than what they currently qualify for. And let's suppose that this first-time home buyer, or someone, I think it's going to have to be owner-occupied to do this, I'm sure, and maybe first-time home buyer driven. Well, what if the down payment was such that they could afford it and they can maybe afford their closing costs as well or get help with that? But the lower down payment's going to negate things like gigantic student loans or a car payment or maybe an entry-level job position that's likely to increase in salary over time. So a lot like a 2-1 interest rate buy down, where in the first year the interest rate is 2% lower than the given rate, and the second year is 1% lower, and then it's just the actual interest rate for the rest of the loan. This works a little bit differently. This builds in that super low monthly mortgage payment for all 50 years. Now, keeping in mind that it's unlikely that anybody's going to go ahead and stay there 50 years. I mean, somebody will. But right now, how many people actually stay in a home 30 years and pay off the mortgage? I would suggest it's relatively few. And, we can all type in Google and figure out what that number might be. But let's just say not a lot. Because it says everywhere that people move every 7, 8 years, even once every 10 years. Not a lot of people doing this as far as staying with the property the whole 30-year term or the whole 50 proposed years of a term. So if we have a lower monthly payment and the affordability now goes up, and it means that buyers do not have to pay off student loans or do some witchcraft to make that piece work, and they can actually go out and buy a car and buy some groceries and maybe, do some things outside of work and not have 3 jobs. Maybe that's a win. And if you're worried about all the interest paid, they have these mortgage calculators. What if you qualified for the rate and term of a 50-year note, which is a lower monthly payment? But you could easily type in what a 30-year payment would be. And if you could make it, well, now things get really interesting. let's suppose that you qualify at the lower payment, but you could pay more money every month ongoing towards your mortgage payment. What if you could actually pay the 30-year payment from day one? I'd argue you could pay it off in 30 years just like the other one, but you qualify for the higher price today as opposed to starting in a starter home, in a home that you may or may not want to stay in a long, long time. You may have less deferred maintenance, less repairs. You may not have to buy a new roof because of this flexibility with a 50-year mortgage. Maybe you can get more in the actual purchase from the seller, whether they put the roof on there, or maybe it's a newer home where it doesn't need a roof right now, or an HVAC, or an electrical update, or a plumbing update, or something else that can be rather costly. You see, the flexibility means that if you have a minimum payment, just like a credit card, you can pay more, and that would eat away at the interest that's due over time. I would argue that with the lower monthly payment and throwing cash at it, you might actually have a chance to amortize it even faster than if you started with a 30-year note, because you would see the payments coming, the payment will stay the same, but you see the balance coming down. And as you get further into employment, if you're a first-time home buyer, there's a real chance that you're going to have bonus raises and opportunities and tax refunds that you can put directly towards the principal. I think there's a lot to be said for a 50-year mortgage. Now, believe me, on its face, is it a scary proposition? Of course it is. But it doesn't have to be a bad thing. And if the whole exercise teaches us anything, someone might look at a 30-year mortgage compared to a 50 and feel maybe that they can only qualify for the 50-year mortgage and later find out that they can actually do a 30-year mortgage or a 25-year mortgage or a 20 or something like that. But with self-amortization, where you pay additional to principal, you could really be, your own guide on this journey of paying off your home if that's what you choose to do. The hidden gem is, let's suppose that you live in this house for long enough with a 50-year term, and you choose to save money for the next house. This home could now have the potential to be an investment property for you, where you live in it a certain number of years and then rent it out. And because you've got the lower monthly payment over 50 years, it's a chance for more cash flow too. So there's a wealth building strategy attached to this. And if you're buying a home at, let's say, 20 or 25 years old, and 50 years down the road, retirement might be easily 75, because I think it's 70 now, or 67. That might be an additional retirement income to you. The house will be paid off, and you'll have the revenue coming in. It'll be similar to having a 401k or a Roth IRA or something like that. It's just another revenue stream. So I find a lot of positives amidst all the negatives of the 50-year mortgage. I would say this: just examine it. Make the decision that's right for you. Give me some feedback, how you feel now that you have all this additional information that isn't being put out there, at least often or in one place. If it's a 50-year mortgage, okay. It might be right for you. But either way, now you've got the information. Listen, I want you to hit the subscribe button. I want you to get this content as often as you can so I can help you out. This is Ron Wysokarski for the Black Hole of Real Estate.